Hi guys, the purpose of this video is to show you the differences in the journal entries on the perpetual and the periodic method. Okay, so I've written down 5 types of transactions which could occur in a question, and I'm going to show you the differences between the perpetual and the periodic method journal entries. The first transaction is a purchase. So if you're using the perpetual method and you've made a purchase, your journal entry would be debit my inventory, credit my accounts payable. Okay, I'm writing accounts payable, but obviously it could be bank if you have purchased it for cash. On the periodic method, you debit purchases and credit accounts payable. So the differences between the perpetual and periodic method when you are making a purchase is you debit inventory for perpetual, but you debit purchases for the periodic method. The next transaction is a sale transaction. If you are using the perpetual method and you are selling inventory, you debit accounts receivable or bank depending on how you sold it, and you'll credit sales. You have a second journal entry for the perpetual method. You debit cost of sales and you credit inventory. If you are using the periodic method and you made a sale, your journal entry stays the same as the perpetual. You debit accounts receivable and you'll credit your sales. The difference here is that there is no second journal entry. So if you're using the periodic method and you're making a sale, you only have the first journal entry, there is no second journal entry. The third transaction is a purchase return. So this is when we are the ones returning to our supplier. The journal entry is the opposite of what we've done when we purchased the inventory. So when we purchase the inventory, we debited inventory and credited accounts payable. Now you will debit accounts payable and you will credit your inventory. And then you do the same thing for the periodic method. You say, when I purchased my inventory, I debited purchases and credited accounts payable. Now I need to do the opposite. So you're going to say debit accounts payable, credit purchase returns. So very importantly over here, we don't credit purchases directly, we credit an account called purchase returns. For the sales returns, we ask ourselves, what was the entry when we sold the inventory? Now let's do the opposite. So when you sold the inventory, you debited accounts receivable and you credited sales. Now for when our debtors are returning to us, we will debit sales returns and we'll credit accounts receivable. And then for the perpetual method, we had a second entry, so we will do the reverse of what we done in that entry. Debit inventory, credit cost of sales. For the periodic method again, we'll go back to when we sold the inventory and we'll do the opposite. So we will debit sales returns and we will credit accounts receivable, and there is no second entry because there was no second entry when we sold the inventory. The last transaction in the table is additional costs. So remember, additional costs are the costs you incur to bring the inventory to the location and condition as you intended. So additional cost example would be import duties or transport on inventory, any carriage or railage, etc. So if you're using the perpetual method, we say we capitalize those costs to inventory directly. So you'll debit inventory and you'll credit accounts payable or bank depending on how you have purchased it. And on the periodic method, you will debit your specific type of account. So if you had paid for transport, you're going to say debit transport on purchases. And you'll credit your accounts payable. So very importantly, for the additional cost, on the perpetual method, you debit inventory directly. But on the periodic method, you open up that specific type of account, transport on purchases, and then you'll credit accounts payable.